Good evening. Welcome to POOIS, Professional Organization of Iranian Americans in Atlanta. One of the missions of POOIS is to honor, pay tribute, or remember our Iranian American scholars, scientists, and dignitaries who have made a difference in the world. Tonight, we are honored to have an eminent and world-renowned economist as our guest speaker, namely Dr. Mark Zandi, Chief Economist of Moody's Analytics, for which I am truly indebted to Dr. Kamelia Alavi for having introduced him to us. POOIS is an affiliate of Kanoon, or Persian Cultural Center, and is a non-religious, non-political, and a purely independent organization. I have the honor of being the president of POOIS, which has a board of directors different from that of Kanoon. The lectures are all in English so that our Iranian American generations 1.5 and 2, who unfortunately do not know Farsi, can benefit from them. POOIS works tirelessly to uphold the three pillars of its mission. Number one, to provide an opportunity for Iranian American professionals to network and support each other, to help the next generation of Iranian American professionals to succeed and prosper, to promote a positive image and counter the negative media depiction of Iran and Iranian professionals. Please support POOIS by donating via POOIS.net. Now I briefly introduce Dr. Zandi. Dr. Mark Zandi is an Iranian-American economist who is the chief of Moody's Analytics, where he directs economic research. Dr. Zandi was born in 1959 in Atlanta, Georgia, and grew up in Radnor, Pennsylvania. He's the son of Professor Iraj Zandi, a professor at the University of Pennsylvania. He received his BS, MS, and PhD from the Wharton School of the University of Pennsylvania in economics. Dr. Zandi's research interests encompass macroeconomics, financial markets, and public policy. He analyzes the economic impact of government spending policies and monetary policy response. A trusted advisor to policymakers, he has testified before Congress on the economic outlook, the nation's fiscal challenges, fiscal stimulus, and financial regulatory reform. Dr. Zandi publishes on mortgage finance reform and the determinants of foreclosure and personal bankruptcy. He was one of the first economists to warn the financial crisis of 2008 in 2005. Dr. Zandi is a regular contributor to the Washington Post and the Philadelphia Inquirer, is a frequent guest on CBS, Face the Nation, Fox Business, C-SPAN, CNBC, NPR, Meet the Press, CNN, and various other media outlets. Tonight, we have an exclusive honor to have him as a speaker, for which I am monumentally grateful to our friend, Dr. Kamelia Alavi, who introduced him to us. And Dr. Modarisi, could you please, put the first video, and the first and the only one.
Surrounding this economic climate and what that means for companies' bottom lines. Today, I'm speaking with Chief Economist at Moody's, Mark Zandi. Will AI transform the way companies do business? And what does that mean for workers? And what does it mean for employers?
AI has the potential for really changing a lot of business practices. It's coming on very rapidly. Businesses are already aggressively investing in these new technologies. History is a guide. It does take time for those technologies to be incorporated into business practices and to have a big impact. We tend to see the technology, we can see it, we can feel it, we can taste it, we know it's coming, therefore it should happen immediately. It doesn't happen that way generally. It happens over periods of several years, even a couple decades. But I think all businesses will benefit and also be challenged by artificial intelligence.
I know a lot of employees are worried they're going to be replaced by AI, and maybe employers are thinking, great, I can not pay, workers and I can have them work 24/7. Do you think that that will happen anytime soon? I mean, you kind of alluded that maybe not, but you tell me.
I think AI will have differential impacts, challenges, and opportunities for both workers and employers. I mean, obviously for workers, the challenge is that their job will be eliminated or replaced or significantly changed in some way that will require the worker to get other skills and experiences to be able to navigate in the world with AI. Opportunity, because if you're able to harness the power of artificial intelligence in your work, you should be able to command a higher wage, and the fact that AI is lifting everyone's productivity. For businesses, the challenge is it could change the competitive landscape quite dramatically. A company's comparative advantage may be significantly disrupted by the fact that AI has come on and allowed other businesses to enter into the marketplace with this new technology that allows them to compete. And of course, the benefit is productivity gains. I mean, businesses are scrambling to try to figure out how to raise the productivity of their labor force. They know that it's going to be hard to find workers in the future given demographic trends, aging out of the workforce by boomers and weaker immigration. So that is a benefit. So there's challenges and benefits to workers and employers.
What would you say is the biggest risk that companies are facing right now?
The biggest threat that businesses face, I think, at this point is just high interest rates and a lack of credit. Because of the banking crisis and because of the Federal Reserve's aggressive policy of raising interest rates over the past year, businesses are struggling. And that, I think, is particularly difficult for smaller, mid-sized companies that don't have access to a lot of sources of funding. The big guys, they can go into the capital markets and raise funds if they need to, and probably have a bigger cash cushion anyway. But for smaller, mid-sized companies, that's a problem. I think at this point, they're the biggest threat to their business.
All right, inflation. It's hitting all of us individually, but what does it mean for companies and how they're changing their investments?
The high inflation is creating a lot of cross currents for businesses. I mean, obviously, it's raising costs, the cost of labor, the cost of materials. So businesses are struggling, trying to figure out how to manage those higher costs and maintain their margins and their bottom line. But it's also allowing some businesses to raise prices more aggressively. We've seen since the pandemic has hit, inflation took off, that overall economy-wide margins are wider than they were prior to the pandemic. So that would suggest that businesses, at least on net across all industries, have been able to pass through and then some those increases, and it's actually helped to lift the bottom line and make earnings even stronger. I suspect that's not going to continue going forward as inflation moderates. I mean, the Fed's working really hard through higher interest rates to cool off the economy, get inflation back in. We'll start to see competitive pressures intensify and those margins come back down to something that was more consistent with pre-pandemic. But for the time being, businesses are enjoying wider margins and better profitability.
Will we see a recession in the next year, or why do you think a recession has stalled?
Recession risks are high, and we're in a world of high inflation and the Federal Reserve that's been raising rates very aggressively to try to quell that inflation. So historically, in that kind of world, recessions often follow. Not always, but more often than not. We have a fighting chance to get through this current period without an economic downturn. And it's going to, I don't want to be Pollyannish, it's going to be a tough 12, 18, 24 months. But I think we could avoid a recession because inflation is moderating. We are past the worst of the fallout from the Russian war and the pandemic. The Federal Reserve's higher interest rates are beginning to slow the economy. Wage growth is slowing. Price pressures are starting to abate. Probably even more importantly, the economy is amazingly resilient due to factors that are kind of unique to this period. For example, the excess savings that consumers built up during the pandemic, that's the extra savings that they wouldn't have done without the pandemic because they were sheltering in place. So particularly high-income households and middle-income households have a lot of cash they've been using to supplement their income and maintain their spending even in the face of high inflation. And then business people have done a really good job maintaining their payrolls. They're not laying off workers to any significant degree. And that, I think, goes to the fact that business people have been struggling with labor shortages even before the pandemic, realize that they're not going away anytime soon given demographics, given the aging out of the workforce by boomers, my cohort, given weak immigration. And so I think businesses are loath to lay off. And if they don't lay off, businesses don't lay off, I don't think we go into recession. It's the layoffs that spook consumers that then stop spending and push the economy into an economic downturn. And right now, that doesn't feel like that's going to happen.
Makes sense. All right, little bit of a pivot. Is global warming changing any of your economic models? How are economists and investors adapting to the changing environment?
We are incorporating climate risk into our modeling and into our forecasting. It is starting to impact our longer-term economic projections. When I say long-term, more than a year or two. Over the next 10, 20 years, the biggest economic cost is going to be related to so-called physical risks. Those are, the damage created by hurricanes and flooding and wildfires, which are occurring with greater frequency and causing increased economic loss that we're all going to have to struggle with. The other cost is so-called transition costs, the cost of moving from an economy that's dominated by fossil fuels to one that's driven by clean energy and green energy. And that's a cost. You can see that the Inflation Reduction Act is an effort to provide tax credits to promote that transition, but that's a cost to taxpayers. So that's going to be borne by all of us for a long time. It's not like something that's going to drive the economy off the rails at any given point in time. It's more like a weight on the economy, kind of like a corrosive on the economy. It's weakening underlying productivity growth, adding to the cost structure of businesses and financial institutions, and just kind of throwing sands in the gear and making it more difficult to navigate. It's a problem for a lot of businesses, but it's not, in general, an existential one, for businesses.
Last question. Will the U.S. remain the world's leading economy?
The U.S. will indeed remain the world's leading economy, at least in my lifetime. I'm not worried about it. There are lots of challenges, but at the end of the day, we're still the AAA credit on the planet. We're working hard to get that credit rating down, I'll have to say. But when push comes to shove, we figure out how to, get it together and get the job done. Where the best and the brightest of the world want to come to go to school and to live and to work. And that's because you have opportunities here that you can't get anywhere else. As a result, if you can continue to attract the best and the brightest, we'll be just fine. We'll continue to drive the global economic train for as far as the eye can see.
Okay, thank you so much, Dr. Madarsi. It is indeed an honor for us, to have Dr. Mark Zandi, a world-renowned economist. And on behalf of Kanoon and on behalf of POOIS, I extend my gratitude and appreciation to you. And Dr. Zandi is going to talk about the business cycle moments of truth. Dr. Zandi, the floor is yours. Thank you so much.
Well, thank you for that wonderful introduction. I want to thank Umino and the group and Camellia for the opportunity to participate, particularly giving me 3 hours to speak. That's really very kind of you. No, only kidding. I know an economist for more than a half hour. That's pretty difficult to digest on a Friday evening. So I admire you for being here and giving me this time. But maybe what I'll do is I'll give you a sense of how I think the economy is going to perform over the next year or two, and then turn it back for the next half hour or so, and then turn back to the group to see what kind of questions and comments that people have. And maybe I will stop along the way just to break things up a little bit and see if there's any questions that people might have along the way. It might be pretty hard to listen to an economist for even 30 minutes here on a Friday evening, but I may stop along the way. Does that sound like a good game plan, Mano?
Yes.
Does it sound okay? Okay, very good.
We are used to this, so if you just keep the questions for the end of your presentation, I would appreciate it more.
Oh, okay, fair enough. Happy to do that for sure. Yeah. And let me ask, are you up for a few slides? Would you like a few slides? Would that be helpful in the conversation? It would be? Okay. Then let me share my screen and I'll show a few slides. Okay, does everyone have that? Can you see the slides?
Yes.
Yeah, okay, very good. Okay. Bottom line, I think recession risks are high, uncomfortably high, but they are receding, and we have a better than even chance of getting through the next year or two without an outright economic downturn. There's enough going right for the economy. There's enough differences between now and times past that with a little bit of luck and some reasonably good policy making, we'll be able to get through without suffering an economic downturn. I do think, I don't want to be Pollyannish, as I said in the video, recession risks are high, and they're high because of history. You know, when we do forecasts, when we forecast the economy, really when we forecast most anything, as business people, as investors, as individuals, we base those forecasts on history. We look at what happened historically and use that as a basis for making an assessment of, you know, where we're headed. And you know, based on history, recession risks are high. The economy is struggling with, or has been struggling with, very high inflation, in my view, largely because of the ongoing fallout from the pandemic and the Russian war in Ukraine. We'll talk about that a little bit more in a minute. But nonetheless, when you're in a world of high inflation in a Federal Reserve that's aggressively pushing up interest rates, historically that has landed us in recession more often than not. And also, a number of the leading indicators that economists tend to use to gauge recession prospects, they're all signaling recession. I'll just mention one very briefly. That's the shape of the Treasury yield curve. That's the difference between long-term interest rates and short-term interest rates. Typically, in a well-functioning economy, long rates are higher than short rates. But every once in a while, the so-called yield curve inverts when short rates, because of Federal Reserve tightening, rise above long-term rates. That's called an inversion. And when that has happened historically, that has presaged with a great deal of accuracy future economic downturns. And the yield curve, again, the difference between long-term interest rates and short-term interest rates, inverted a little over a year ago. So that would be, again, based on history, a strong indication that recession is likely, more likely than not. I'm not going to go into any detail about why the yield curve is a good prescient indicator of future recessions, but I'll make a quick advertisement. I have a podcast every week called Inside Economics, and I had on the podcast, I'd say 3-4 months ago, Campbell Harvey. Cam is a Duke professor of finance, and as part of his PhD thesis, he popularized the use of the yield curve as a predictor of future recession. If you really want to know how to measure the yield curve and understand the link between the yield curve and the economy, I would recommend that you listen to that podcast. But the point is, the curve is inverted a little over a year ago, and history would say, hey, you know, recession is likely. So, but I'm here to tell you the most likely scenario going forward is that history is not going to be an accurate guide. This time, these are the dreaded 4 words. This time is different, that we'll be able to make our way through without an economic downturn. And let me give you a few reasons for that optimism. Reason number one, inflation is coming in. It is moderating. You can see that here. This is the Consumer Price Index, percent change year ago, CPI. This is data from the first quarter of 2019 through the end of 2024. So you can see where history ends and forecast begins. And we've made a lot of progress already as the fallout from the pandemic on supply chains and the job market and the Russian war in Ukraine and its impact on oil and food and other commodity prices are increasingly in the rearview mirror. We've seen inflation come back in. In fact, inflation peaked back in the summer of last year. In June of 2022, CPI inflation was almost 9%. We're now down to 3.5%, 4%. You can see, I expect that moderation will continue as we move forward here over the next year and a half. You know, I as a professional economist, I forecast many things. Some things I'm very confident, some forecasts I'm very confident in, some forecasts not so much. I'm actually quite confident in this forecast. One of the largest contributors to the still elevated rate of inflation is the cost of housing services. How much does it cost us to live in our homes, either as homeowners, as renters? And the good news, at least from an inflation perspective, is that rents which drive the cost of housing services, have gone flat to down since the end of last year. This goes to a very significant increase in supply, and that supply will only grow as we move into through the remainder of the year into 2024 and 25. There is approximately 1 million multifamily units in the pipeline going to completion. They all got bottled up during the pandemic because of supply chain disruptions. Builders couldn't get materials, they couldn't get appliances, difficult to find labor, particularly in places like Atlanta, where immigrant workers are very important to the labor force. So all that building came to a standstill. But now, as the pandemic has faded, as supply chains have improved, as labor has become more ample, we are now seeing those projects come to completion, and that means a lot of property units are going to come to the market. Vacancy rates they're still very low, but they are going to rise. That's going to put continued downward pressure on rents through next year into 2025, and that will put downward pressure on the cost of housing services and allow inflation to continue to moderate and come back in. I also feel pretty good about this forecast in the sense that the Federal Reserve's very aggressive increase in interest rates has cooled off the job market. Job growth is slowing. Businesses are now starting to respond by slowing their hiring. They're cutting back hours. They are using temp help less aggressively. And the result is that wage growth is starting to moderate, which is important in terms of getting the inflation in the service side of the economy back down. Services like healthcare and hospitality, educational services, very labor intensive. When wage growth is strong, businesses in those industries have to raise prices aggressively. But now with inflation, with wage growth moderating, that'll allow those businesses to kind of pull back on their price increases, and that should help. So reason number one for some optimism about the economy, why we should be able to avoid a recession, inflation is coming in. And it will allow the Federal Reserve to forestall any further rate increases. And that's the point of this chart. This shows various interest rates back to 2015. Again, you can see I'm showing you a little bit of forecast. That's a shaded part of the bar. The federal funds rate target, that's the interest rate that the Federal Reserve controls. That's the black line. You can see how aggressively the Fed has increased interest rates over the past year and a half. But if I'm right about inflation and that it's coming in reasonably gracefully, that should be enough to convince the Federal Reserve not to continue to raise interest rates. And that's really key to allowing the economy to kind of navigate through this period without going into a downturn. You will notice that I don't expect the Federal Reserve to start cutting interest rates until the second half of next year. I think the bar is quite high for rate cuts. The Federal Reserve will have to see that, my forecast for inflation is actually coming to pass before they feel comfortable enough cutting interest rates. And the other thing you'll notice is that it'll take some time before the yield curve becomes positively sloped again. You can see the federal funds rate target is well above the 10-year Treasury yield. So that's federal funds rate is a short-term interest rate, 10-year yield, a long-term rate. Short rates are above long rates. The curve is inverted, but it's going to take quite some time before the federal funds rate target comes down enough that the curve becomes rightly sloped again, positively sloped again. That's really critical, particularly to the banking system and the financial system, because the banking system is the yield curve determines the net interest margin of banks, the difference between how the cost of funds that the banks use to make loans and the interest rates they receive on those loans. And when the curve is inverted, their net interest margin is very flat, or they have no margin, and thus this indicates that given this forecast, if I'm right, the system will remain under significant pressure. Net interest margins are going to remain very compressed, over the next year, year and a half. So something to watch. But broadly speaking, good news. If I'm right about inflation, if I'm right about the slowing in growth, that means the interest rate hikes by the Federal Reserve are now over, and that is a good reason to be optimistic about the economy's prospects. Let me give you another reason for some optimism, and that is the American consumer. The American consumer is hanging tough, doing their part, and that's the point of this chart. This shows a real consumer spending after inflation indexed to equal 100 in February of 2020. So this is the month before the pandemic hit. I'm showing you data, monthly data, from the start of 2018 through the most recent monthly period, which is July. And you can see the blue line is overall spending, and you can see that it recovered reasonably gracefully from the pandemic. It got obviously crushed during the pandemic, but because of all the government support, quickly made its way back by the spring of 21. That's when the American Rescue Plan that's the rescue plan passed under President Biden. The economy got back to its trend growth. That's represented by the black dotted line. And as of this point in time, consumer spending is exactly where you would have expected it to be if there had been no pandemic. Now, not to say that the pandemic hasn't had an impact on spending patterns. You can see that also in the chart. Good spending on things jumped during the pandemic because we were all sheltering in place. So, for example, I was sitting on my back deck for almost a year because the office was shut down. And when you're sitting on the back deck, you're not going to ball games, you're not going to restaurants, you're not traveling. You're sitting there buying stuff for your back deck. So, like, now my back deck is beautiful now. In fact, I've got 2 power washers. I don't know how I got 2 power washers, but I got 2 power washers during that period. And if you don't have a power washer and have not tried using a power washer, I highly recommend it. Very empowering. You got to be careful not to destroy things, but if you figure that out, very empowering. But nonetheless, you can see good spending has gone flat since that initial sheltering in place, but it hasn't reverted back to its pre-pandemic kind of trend. Conversely, services, that's travel, that's entertainment, that's educational services, healthcare services, that got crushed because we couldn't go out. It has made its way back, but it's still not back to where it would have been if there had been no pandemic. So overall spending, right down the strike zone, exactly where you expect it to be. And given that you guys are in Atlanta, I'm assuming you're all Atlanta Braves fans. So, and I because I'm in Philadelphia and I'm a Phillies fan, I have a problem with that. But you have a really good ball team. So I'm going to use baseball metaphors here. Overall spending is right down the strike zone, but there is still some shift in spending. But consumers are hanging tough. They're doing their part, and for good reason. We have a lot of jobs. We have low unemployment. Wage growth is now stronger than the rate of inflation because inflation has come in. Wage growth is moderated, but not to the same degree, particularly for low-wage workers. Debt service is low. Many households locked in the previously low interest rates through refinancing waves. The average interest rate on existing mortgages is 3.5%. The current mortgage rate is 7.5%. So, people are locked into their homes, but they are insulated from the higher rates. They're feeling wealthier than they were pre-pandemic. Yes, stock prices are down from the all-time high. House prices have weakened from the all-time high, but despite that, people are still a lot wealthier than they were pre-pandemic. And many high-income households, middle-income households, still have excess saving that they built up during the pandemic. Because they couldn't spend, they saved a lot of that money. Not low-income households; they've kind of blown through that, and that's why we've seen a pickup in credit card borrowing and consumer finance borrowing. But middle-income, high-income households continue to have a lot of cash sitting in their deposit accounts at banks, and that's allowing them to continue to maintain their spending. So as long as the American consumer does their part, hangs in there, the U.S. economy will be fine. And by the way, it will also help out the entire global economy because American consumers buy everything that's produced here and then a lot of things that are produced everywhere else in the world. And so if the American consumer is spending, that's kind of driving the global economic train and should help allow most of the rest of the world to continue to avoid an economic downturn as well. Okay. At this point, you should be feeling reasonably okay. I've given a couple of reasons for optimism. I could give more, but it would take a longer period of time, so I'm going to stop. And now I'm going to turn to talk about some of the risks to the economic outlook, because I do think it is important to consider the risks. And they're mostly to the downside, not exclusively. We can talk about some of the things that may turn out to go better than anticipated, but there are, I think, at this point, still more downside risks. And that, I think, is nicely encapsulated in this chart, which I call a risk matrix. The x-axis, the horizontal axis, measures the severity of the risk that is shown. I kind of think of it like a present value of economic loss if the risk were to occur. So it accounts for the loss at the time of the shock, but also accounts for the timing of the shock. So if it's longer into the future, then the present value is lower and it's to the left of the x-axis. The y-axis is the probability of that risk, the severity, the probability, the likelihood of that risk. Obviously, this is very subjective. Just to acclimate yourself to the chart. So, for example, if you look into the northwest of the matrix, you see student loan distress and federal government shutdown. This is going to happen. We know that student loan borrowers need to start repaying on their debt in October. That is 100% probability. In the government shutdown, the federal government, as you know, doesn't have, as of October 1, at the start of the new fiscal year, does not have a budget, and won't, until lawmakers pass a budget, won't have one. And if there is no budget, then there's no funding. If there's no funding, the government shuts down. I, at this point, feel like there's a very high probability that the government is going to shut down on October 1. But you'll also notice that I think these shocks have small macroeconomic effects. And just to kind of give you a sense of that, in the case of student loan distress, there's 21 million borrowers that will need to start repaying on their debt. The average monthly payment is about $300. If you do the arithmetic, that's about $75–80 billion a year. But the President Biden, has issued an executive order saying to servicers of student loans that if a borrower doesn't pay, if they're late, not to report them to the credit bureaus. So there is a high probability that several million borrowers are just not going to prioritize their student loan payments. They'll prioritize other spending because there's no economic penalty for not paying. Another reason to think that the impact will be a lot smaller is that the administration has set up a number of so-called income-driven repayment plans that allow borrowers to go into these plans if they spend more than a certain percentage of their income on student loan debt, and it caps it at a certain percentage, and that will reduce the payments from $300 a month to as much as half of that. And then the final thing I'll say on that point is that many of the student loan borrowers are actually borrowers with higher degrees and reasonably good incomes, other resources. And it's not that if they have to shell out more money to make their student loan payment means that they're going to cut back their spending by the same amount. They are going to use their other resources to kind of fill that gap. So if you kind of do the arithmetic here, the end of the moratorium isn't great for the economy. It is a negative for growth, but it's a relatively small one. Quickly on the government shutdown, that is going to, as I said, likely going to happen. But my expectation is that it won't last more than a couple, 3 weeks. The political pressure here is going to intensify very quickly. I do think House Republicans will be blamed for the shutdown and the political pressure to acquiesce and come to agreement on some form of budget or continuing resolution will be very, very intense. And if history is a guide, it'll take a couple, 3 weeks for that to occur. I think a good kind of milestone is that when the government shuts down, federal government employees don't get paid. And so when their first check is not paid is when people are going to start really getting upset. And that's when the political pressures will intensify. But let me say, I do think it is really important to focus on the risks that are in the northwest part of the chart. And you can see, I do think at the top of the concerns is that the Federal Reserve will make a mistake here, that they will continue to raise interest rates. As you recall, in my optimistic baseline, I was assuming that the rate hikes by the Fed are over, but I could be wrong. Generally, I'm not wrong, but I could be wrong. And if I'm wrong and they keep raising interest rates, at some point in the not too distant future, it won't take too many rate hikes to push the economy into recession. The other risk I want to call, two other risks I want to call out. One is oil prices. That's the other thing that has happened most recently that is of significant concern. We've seen oil prices jump to $90 to $95 a barrel, depending on what grade of oil, what the type of oil we're talking about. That's at the very high end of the range that I think that the U.S. economy can digest without going into recession. If oil prices continue to move higher and go over $100 a barrel, that means the price for a gallon of regular unleaded nationwide is going to go to $4.25, $4.50. And I think that's going to be very difficult for, going back to the American consumer, particularly lower income, middle income households, to digest. And that will suck the wind out of the economy, may even force the Federal Reserve to raise interest rates again. And another reason for worry, for some nervousness there. Now, I'm assuming in my baseline optimism that the Saudis are going to manage their production cuts in a way that will cap oil prices around 90. I think the Saudis want oil between $80 and $90 a barrel. 80, they need above 80 to compensate, to be able to finance all their fiscal needs and to generate the funds they need for the investments they're making in their economy. So they need 80, but they don't want much above 90, because above 90, then it causes demand destruction. People stop driving cars as much. It reduces demand. And if it stays above 90 for any length of time, it's going to incent the transition to green fuels, green energy much more quickly. And I don't think they want to see that happen. But that's just an assumption. And moreover, very difficult for the Saudis to calibrate things given the cross currents in terms of global demand and supply. So very significant risk. Finally, one more risk, and then I'm going to give you a couple indicators to watch to gauge which path we're going to go down, and then I'm going to stop. The final risk I want to call out is the banking system. As I mentioned earlier, the banking system is under tremendous pressure. There was a crisis back in June. Regulators, the Federal Reserve, Treasury stepped in, guaranteed the deposits of all depositors, insured, uninsured, in failing institutions, set up a credit facility called the Bank Term Funding Program to help banks fund themselves by borrowing against their security holdings at par. That has worked to date, but given the fact that the yield curve is still inverted, margins are still narrow, given that credit quality is starting to weaken, particularly in the commercial real estate market, and that likely will intensify, given that loan growth is going to remain slow because of a tightening in underwriting, and given higher regulatory costs, as you know, because of the crisis back in March, the Fed and other regulators are putting forward much stricter capital requirements on the bigger and mid-sized banks. Given all of that, the banking system, the operating environment for the banking system is very problematic. And I think that there is a significant possibility of another financial event, either in the banking system or the rest of the financial system at some point over the next year or two. So something to watch and consider. Finally, let me give you a couple indicators to watch out for, and then I'll to gauge whether my optimism is going to be correct or whether we will suffer a recession. The first is consumer confidence, as measured by the Conference Board. The Conference Board is a business trade group. They've been conducting this survey for monthly back into the 70s, and you can see the results here. The recessions since the 1980s recession are delineated by the red shaded bars. At the end of the day, a recession is a loss of faith. Consumers lose faith that they're going to hold on to their job, and they pull back on their spending. That resilient consumer I was talking about packs it in, runs for the bunker, stops spending. It's a loss of faith. A recession is a loss of faith by business people that they're going to be able to sell whatever it is that they produce, and they start laying off workers, and you get into this kind of self-reinforcing negative cycle. So confidence is really, in psychology, is really important. And the good news is that confidence, as measured by the Conference Board today, is close to where it has been on average over the entire history of the survey, just a little over 100. And there is no indication at this point that consumers are losing faith. They're holding their own. They're hanging tough. And as long as that's the case, we should be good. But if we start to see consumer confidence begin to weaken significantly quickly, that would be an indication that I'm going to be wrong and a recession will ensue. And then finally, because I am the chief economist of Moody's, I'm in the capital markets, I think it's important to call out an indicator from the bond market, and that's what's shown here. This is the difference or spread between interest rates on bonds issued by below investment grade or junk businesses, so-called high yield bonds, and risk-free treasuries. That spread represents the compensation that bond investors in corporate debt require to be compensated for the risk that the corporate borrower defaults on that debt. Historically, you can see that, and I'm showing you the spread back into the mid-90s when the junk corporate market was put on the planet by Michael Milken. The average spread over that period is 5 percentage points or 500 basis points. And you can see at the current point in time, it's well below that. It's 400 basis points. So corporate bond investors are saying, hey, I think corporate borrowers are going to continue to pay in a timely way. I'm not worried about a default. Recession doesn't seem likely. But having said that, this is something that I think is important to watch going forward to gauge, again, whether we're headed to recession or not. So bottom line, just to repeat what I said at the beginning, recession risks are high. They're uncomfortably high, but they are receding. And I think odds are that we will be able to avoid an outright economic downturn with a little bit of luck and some reasonably good policymaking. And with that, Mano, I'll turn the conversation back to you.
Thank you so much. Thank you so much, Dr. Zandi. It was a beautiful presentation, and we learned so much, although we have a lot of other questions,